Hey guys, what's going on? This is Hayden Crabtree. Today I have a very special video for you, an area of my expertise, and that's how to find and how to value and to tell if a storage facility that's for sale is a good deal or not. So this is gonna be really probably one of my favorite videos I've ever done. It's actually gonna be twofold. You're gonna be seeing me here explaining the video, and then I'm also gonna share my screen with you. I'm gonna give you access to a spreadsheet so that you can analyze these deals, and I'm actually gonna show you live time where we can go out and analyze some deals that are currently on the market. So, if you guys have any interest in being a self-storage investor, this is definitely a good video to stay tuned for the entire time. If you have any questions whatsoever through this process, drop a comment below. I'll be happy to answer any of those. And of course, if you don't know the benefits of commercial real estate investing like in self-storage, pick up a copy of my book, Skip the Flip, Secrets the 1% Know About Real Estate Investing, in PDF or audio copy, absolutely free, in the link in the description. So with that being said, let's jump over to my screen. I'm gonna show you guys exactly how to value a self-storage deal and tell if it's a good deal or not a good deal. Let's dive in. So as you guys see here, I'm just on Google, and I'm gonna show you where I go to look for self-storage deals that are currently on the market. So what I'm gonna do, the first thing I'm gonna do is I'm gonna go to LoopNet.com, okay? And so LoopNet is it's an exchange, it's a marketplace, just like Zillow is for houses. LoopNet is one of several different, listing platforms for people to put commercial properties for sale. So if you're here, there's a lot of different places we can go. LoopNet also generally provides some news, different things going on in the industry. So you can come here, you can read, stay up to topic. But what I'm gonna advise you do, the first thing is click here on advanced search. And so the advanced search should pull up a big map for us. And then we're gonna try and refine from here. So there's all these different categories we can go through. I'm just gonna click this X button. I'm gonna come up here to property types. Then all of these different kinds of property types we could search by. I'm gonna come over here to specialty, click the little drop down arrow, and I'm gonna click self-storage. What that should do is it should show me all the self-storage properties for sale in my given map area. If I adjust my map area, it'll change. So here are all the self-storage properties for sale, pretty much in the entire United States. And I just go through here and I try and find some deals that look really, really interesting to me. Here's just a bunch of different listings from all over. I could obviously fine tune in the market that I'm looking in. Not every single market is gonna have something for sale, but I can go through here and look. But we're gonna analyze this property right here today, which is listed for $995,000. So when I click on it, it's gonna bring up another tab, and hopefully it loads here for us pretty soon. Awesome, so we got it loaded up here, and they're gonna show us some pictures of this property. There is no standard format for these listings, but we're just gonna look over it real quick, see what kind of shape the property's in. It looks to be in pretty good shape. It's got a gate with a keypad, which is a good thing. Looks like in this picture, it's got some extra land that it could potentially build out on. So let's read a little bit more about this property. It's got 7 buildings totaling 19,680 square feet. It's fenced, it's lighted, has an access code and detention pond. I didn't read anything about cameras, which is very important in self-storage. There are 127 units, 37 units that are 10 by 24, and 90 units that are 10 by 12. Here's some other facts. They're selling it for $995,000. That's a $51 price per square foot. And that's pretty much all I care about in that section. I'm gonna go down here. This is a great opportunity. Of course, this is written by this guy, Adam Grady, right? He wrote all this. Great opportunity to own a storage unit facility on 7.49 acres. There are currently 7 buildings with 19,680 square feet on 3 acres. There are a total of 127 units, 37, we read that already. The buildings are 4 to 15 years old, so they built it in stages. The larger units have potential to be partitioned in half to create 2 10 by 12s, since they have 2 doors. So what that would mean is that this whole thing could be a unit, and you could run essentially a spot through the middle there to make it 2 units. There is room on the current developed area for 3 additional buildings, plus there is space for an additional drive to access the upper undeveloped 4.5 acres. Property's fence lighted and has a great access code. All buildings have paved drives. Great location. Okay, so that's some pretty good information about the property. Take it as you may. One thing that I always like to note is that this is the sales pitch, right? They're trying to paint the very best picture of this property so that we will be like, yeah, this is great. I want to buy it, right? Not saying it's not great, not saying he's being distruthful. I just always want to form my own opinion about what I'm seeing, okay? So the very next thing that I want to do is I want to start analyzing the numbers on this property to really understand what kind of a financial return am I going to be getting on this property? Because the only thing truly at the end of the day that I care about, don't care how beautiful it is, I don't care about, you know, what kind of shape it is, I don't care about the location. The only thing I, Hayden Crabtree, cares about is what are the numbers, okay? And what are the numbers is the most important question anybody should be asking themselves whenever they're valuing any piece of real estate. What are the numbers? Don't become emotional. Don't get attached. What are the numbers on this property? So what I want you guys to do, if you want to follow along with me to make sure we're all on the same page, I'm actually going to share a spreadsheet that I made to analyze deals, and we're going to use that. And if you want to do this with me, just follow my directions, okay? So the first thing you want to do, go to haydencrabtree.com/resources. And you guys, what you're going to be able to do is you're going to be able to log in here and you're going to get a spreadsheet. So click for access, type in your name, your email address, give me my resources. All right, then we're going to come in here and we're going to scroll down to this section right here. You can see there's a lot of different resources in here if you guys want to go through all those. These correlate in my book, so this is a great spot to be to learn more generally about it. But I want you to go to the free real estate analysis pro forma, and I want you to click here. Now, please, 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 don't email me asking me for access to this document. I'm going to show you really quick, if you just pay attention, how to get a copy for yourself. Because if you try and edit this, the sheet's not going to let you, because I want everybody to be able to use this sheet, everybody watching this video. So what I want you to do is come up here to File. I want you to click Make a Copy, and then it's going to ask you, what do you want to name this? You could name it, you know, the default copy, or, you know, you could say this is, if your name's Tom, whatever, my name's Hayden, so Hayden's copy of free real estate analysis pro forma. I'm going to click OK. That's going to open up another tab, and now you'll be able to actually edit this pro forma. Okay, so very important that you make your own copy that you can go through and use. So I want to walk you through briefly, and at this point what we're doing is we're creating a pro forma. We're analyzing the numbers on this property to understand, is it a good deal? Is it a bad deal? Should I buy this deal? If it's not a good deal at the current price, at what price could it be a good deal? Okay, so we're walking through the numbers, creating a pro forma here. And the way that I have this pro forma, you know, this free pro forma you can download set up, is any box that's in green is probably going to need your input. Most likely, you're going to have to go in, you're going to have to punch in some numbers. So we're going to do this together on this page here. So as we can see, if we want to go back to this listing, $995,000 is what they're asking. Okay, the asking price is not the actual price. Sometimes things sell for over the asking price, especially in today's market, but a lot of times things sell under the asking price. Okay, so don't be afraid that if our numbers don't come up to $995,000 that we can't make an offer on this, because we absolutely can, and we're going to figure out at what price we should. So I'm going to type in here in the purchase price $995,000. For the initial improvements, what I'm going to do here is I know that this place needs, let's go back and look at the pictures here. I know it needs at least a camera system, which I'm going to call $10,000. Looks like it has bollards, looks like it's in pretty good shape, looks like it has lights. I do not see a sign on the property. I would love to have a sign for, you know, the business with our logo on it, with our phone number on it, with our website on it. So I'm going to do two different things, and I'm going to say we need cameras for $10,000, and I'm going to say we need a sign. I'm going to call a sign $7,500, okay? So that's going to be $17,500. And then the closing cost, what I'm going to do on the closing cost, I don't know what the closing costs are in Missouri, which is where this property is. They vary state to state, county by county. I'm just going to do a 1.5% closing cost. So I'm going to do equals this purchase price. I'm going to do the multiply, which is the little star, 0.015. Okay, and that's going to give me closing cost of $14,925. Now, why did I do 0.015? That's just 1.5% of the purchase price of the property. It could be less, it could be more, but that's probably a pretty safe place to put that. So next up, what we're going to go through is we're going to look at the debt summary. So right now what we're doing, guys, is we're just setting up this spreadsheet to go through and actually analyze the numbers. This is kind of like our investment of time putting it together to put out the numbers in a minute. So we're going to get to that part. Don't lose interest in the video. This is very important for any real estate deal that you do, okay? So the debt piece, number one is the rate, the interest rate that I can get on this debt. So for an existing property like this, I can probably, somebody who's experienced in this field can probably go out and get around a 4% interest rate on a property like this right now on a commercial loan. But let's say you don't have experience. Let's say that we're going to get a 4.5%. The bank is going to charge us a little more for our lack of experience. Let's say we're going to get a 4.5% rate. And let's say the LTV, which is the loan to value, the loan to value, right? How much am I buying the property for, which is $995,000, to the loan amount that I'm getting on this. So if I was experienced, I could probably get 80%, maybe 75% in where we sit in today's market. If you're inexperienced, let's call it 70% LTV. So I'm gonna type in 70%. That's gonna show me my loan amount, which is $696,500, which is essentially our LTV times our purchase price. Next up, we're gonna do amortization in months. So this is how long does your loan amortize. If you don't know what that means, read the book, okay? It's explained very clearly in there. It's a free resource you can use to really improve your knowledge. For a commercial deal like this, we're gonna do a 20-year amortization. So 20 times 12 is 240 months. So after I input in all the green cells, the gray cells are gonna spit out information. I don't need to touch those cells. Don't touch them or it'll mess your whole sheet up. So what that's gonna do is it's gonna show us if these loan terms that we put in, again, follow along here, be putting these in on your own copy of the spreadsheet. On these right here, the monthly payment is $4,406. That's how much we're gonna have to pay the bank every single month on these properties. So we need to make sure our property is at least spitting out that much money in order to cover that for the, the bank payment plus the expenses. And we're also, by the way, we wanna make some money too. So what that's gonna do is that's gonna show us we need a down payment of $330,000. What that is that's the sum of these costs, which is $1,027,000 minus our loan amount, and we're gonna have to pay the rest at the closing on the property, okay? So after we've got this purchase price information put in and our debt put in, we're gonna go through and we're gonna start analyzing the income and the expenses and essentially form the actual pro forma, okay? So I don't wanna touch this right now until the very, very end. What I do want to do is I want to go to the income analysis tab, and I want to come back here and I want to read again how many units they had. They said they had 127 units, 37 units are 10 by 24s, and 90 units are 10 by 12s. So we have size, we have 10 by 24, okay, we have 10 by 12, right? If I could type in correctly. Okay, 10 by 12, 10 by 24, they have 37 and 90. So I'm gonna come here to number of units, I'm typing they have 37 and they have 90. Now, we can see our total number of units is 127, which matches up. Now we need to figure out the monthly rate of these. So let's go through and try and figure out what the monthly rate of these units are in the information that they give us. Anybody can come on here and click this information, okay? Let's click on this Flex MLS, which is essentially the market, local market in which they're listing. See what kind of information they give here. Do they give any information about the rates? I am not seeing it, although it looks like they do have some more pictures here that we could always scroll through and look at. Look pretty good. Roofs don't look like they need any work. I'm gonna go back out of here and I'm gonna come to, let's see what's in the property layout. No, they don't give us anything about the rates there. Let's go to P&L. All right, here we go. P&L, which stands for profit and loss, rents and expenses. Prior to October 1st, 2020, we offered discounts to individuals who had multiple units or paid by the year. In October 1st of 2020, we notified these individuals that we will start charging the full rate of $45 for the small units and $80 for the large units. 45 for the small, so I'm gonna come back here. So the smaller one, 45, and 80 for the large. Boom. So whenever I type that in, again, they gave me this information. When I type that information in, it's gonna show me my monthly potential gross income. So what this shows me is that this set of units, the 10 by 24s, if completely full and everybody paid, we'd be getting $2,960 a month. On the smaller units, if everybody paid and it was completely full, we'd be getting $4,050 a month, which leads to $7,010 a month that we could get from this property. And then if we come over here and look, we'll walk through this in just a second. Year one, the potential gross income, that's what PGI stands for, potential gross income. The potential gross income this thing can produce is $84,120 a year. The effective gross income is how much you actually collected, right? Effective, meaning how much did you get in terms of money coming in before you paid anything out. And that's going to be determined by our vacancy rate. Okay, so this green box here, you're going to need to put in your vacancy rate. Vacancy rate is essentially, you have potential of how much you could get, but then you don't always have all the units full. Not everybody always paid. What is your vacancy rate of money in which you did not collect? I have this in the sheet predetermined at 5%, but that's going to change for every single deal. So let's try and figure out what the vacancy rate on this deal is, okay? So here we go. On November 1st, 2020, we raised the rents for all new customers to 50 and the 50 for the smaller and 90. So it says we raised the rent for all new customers. It doesn't mean that they raised the rents on the old customers. So now we've got two different ball games of who's being charged what. We have some people being charged 45, some people being charged 50, some people charge 80, and some people 90. So what I want to do is I want to figure out I essentially want to figure out what is the amount of money that this property could collect. So I'm going to bump this up in the pro forma to the 50 and the 90 number. And you can see that whenever I enter these, I'm going to change 50 and 90. You can watch the PGI change and you can watch the EGI change. So I'm going to go to 90 and I'm going to go to 50. So boom, we just got the ability to make more money just by raising the rents right there, okay? So for many of our customers are still charged on the pre-November rates, but could have their rent increase to the post-November rates at any time since their leases are month to month. FGSG occupies 2 units year-round at no charge, which contributes to the 96% occupancy rate. So we've got a lot of different things going on. Some people get 2 units for free. They say it's a 96% occupancy rate. Essentially what I want to figure out in this analysis is how much money did they collect last year and how much money can I expect if nothing changes in the business, how much money can I expect in year one. So what I'm going to do is they have $79,057 of income. So I'm going to come to this sheet and I'm going to change my vacancy rate until I get to $79,057. That's what I care about. So we're trying to get this EGI number. When I change my vacancy, my PGI won't change, but my EGI will. I'm going to try and get that to $79,000. So of course I'm going to increase my vacancy rate, meaning that I have less money. And just so I don't have to keep clicking back and forth, I'm just going to take this, I'm going to paste it right here, and I want to get this number to this. So I'm going to go to 10%. No, we're still at 84,000. So what if I go to 15%? When I'm at 79,866. So I'm pretty close. I need to go down about another $800. So let's see what we're at 16%. Oh, I went a little too far. So why not 15.8? 79,114. So I'm not much off. So I'm gonna roll with that. I think that that's a good amount of where I want to be at. I'm within $100, so I'm comfortable there. So I've got my income figured out. How much income is this property producing? What is the potential income? They say it's $91,000 a year. What does ours say? Ours say $93,000 a year. So I can tell you this spreadsheet doesn't lie. They might want to check their math. They say the facility is 100% full with a waiting list. This is a huge statement. For me, this should be underlined, bolded, capitalized, put at the very top. If a facility is 100% full with a waiting list and I have customers that are paying below the standard rate, as in they're telling me, hey, we've got people paying 45 and 80, but we could be charging 50 and 90. Guess what? Those people are getting their rent raised. I'm going to raise that income. I'm going to capitalize on that extra income, because if some customers decide to move out because I did raise the rent, that's okay. I've got more people who can come in. I'm cool with that. If people leave, sorry you left, but we'll fill it up. And it's our job as the investor to maximize the income of the property. That's what value add investing is all about. It's not that we're doing these people a disservice. It's that we're doing these people a disservice down here. If these people are waiting for a unit at new rates, they know what the new rates are. We're good. We should raise those rates. We should keep on going. Okay. So what I'm going to do here, this other thing you need to pay attention to is a rent growth rate, which shows our PGI goes up every single year as it continues on. Okay, so this rent growth rate, I leave it 2%. 2% is the targeted rate of inflation. A lot of times it's more than that. A lot of times rents increase in certain products like storage or in apartments, whatever it may be. Rents can increase way more faster than the rate of inflation, but I want to be conservative. I always want to leave that at 2%, so I'd advise you don't change. But if you want to play around with that and see the impacts it has on the numbers, it's a very powerful sell to actually go out and change. The next thing I want to come over and look at is the expense analysis, okay? So they're going to give us some expenses here. They're going to give us the real estate taxes, the insurance, the lawn care, the internet, and the electric. Okay, so why don't we just go ahead and enter these in. So they got taxes right here. Let's put this number in. I'm going to copy this. I actually might mess it up if I copy it. 14,768. Okay, and let's see how much their insurance is. 3,755. The reason I'm doing this is I don't want to lose the formatting on my cells. You'll notice if you just delete this or insert it directly in, I'll probably make it white. I don't want to mess with the sheet, so that's why I'm copying it over and putting it there. Next up, we have lawn care at $880. So let's see, lawn care, $880, pretty cheap. Internet, $828. Do I have internet in here? It's part of the utilities normally whenever I look at it. So we'll do, how much do they say it was? $828. So utilities equals $828. And then we're going to come back here, and electric is $982. So I'm just going to come, oops, I'm going to add $982, and that way our utilities shows both of those. Okay, so we have in here what, oh, I think I messed up. I always do this in my sheet. So I'm going to show you guys a mistake I made. Don't make the same mistake. You probably just followed my directions, but essentially this is the monthly rate, this is the annual rate. I was just putting in the annual rates and the monthly. So what I'm gonna do is I'm just gonna come through here and divide these numbers by 12. The reason I do this is a lot of times I know how much things are gonna cost me every single month. I don't wanna mess the math up, so what I do is I just enter in the monthly rate. So we're gonna come through, divide all these by 12 and see if these are realistic. And utilities equals, I'm gonna put these in parentheses. Follow the order of operations, $150. So they're saying that annually we have $21,213 of expenses on this property. Again, there's a powerful cell here, the expense gross rate, which is essentially inflation. How much of my expense is going to go up by every single year? I always put 2%. So this is what this shows over a 20-year period. So we've gone through, we put in our purchase price information, we put in our income analysis, we put in our expense analysis, and now we can pretty much view the good stuff, which is the pro forma. Okay, so I'm gonna click on this pro forma number, and it's gonna show us our income, our expenses, our debt service, our NOI, our cash flow. I'm gonna walk you guys through each of those lines, okay? So the first thing to note is this sheet has two different sections for valuations. The bottom is residential, the top is commercial. This is a commercial property, meaning we're valued on a cap rate. Again, it's all in the book. If you need a copy of the book, go get it in the description below. We're gonna value this based off of a cap rate, okay? So I'm gonna say cap rate in this market, it appears to be, let's see how big this town is here. 6548. I'm gonna copy this. I'm gonna see how big this town is. I'm gonna see what it's close to. Fairgrove. So say it's right there. Looks like it's outside of Springfield, which is definitely not a primary market. Let's see how far. We're pretty far away from St. Louis. We're pretty far away from Kansas City. This is definitely, Fairgrove is definitely a tertiary market. So there's primary markets, tertiary, secondary markets, and tertiary markets. Primary markets being the biggest, places like New York, Los Angeles. Secondary markets are kind of smaller markets outside of those. So if we were to look at something, Kansas City may be considered a primary, but maybe a secondary market. And then a smaller town outside of it, like maybe Overland Park. I've never been here, but just showing you, for instance, this would be a primary market, this would be a secondary market, and then all of these would be tertiary markets, okay? So it looks like we're in a tertiary market, which means there's less people, there's less economic activity, there's less jobs. It means there's more risk. That means a higher cap rate. So if I go back here to my spreadsheet, it's got a plug-in rate of 7%. I don't think that's true. We want a higher cap rate because we want a lower value. So what I'm going to do is I'm going to plug in probably an 8.5% cap rate. The reason I'm going to do an 8.5% and be conservative is if I lower my cap rate to try and get the numbers to work for me, I'm kind of shooting myself in the foot because I always want to make sure that I'm being conservative when and if I ever do sell that property. I want to make sure that even if I sell it at a low value, that I'm still going to make money, I'm still going to hit my returns. And if somebody does come in and buy it at a more aggressive cap rate, that's fine. That's just gravy, on the top for me, and that's just extra profit. But I want to make sure the deal works at a conservative number for me. And the sales commission, 5%. We might get a little lower. It might be fair. Some people do 6%, but that's mainly on houses, okay? So we're looking at the commercial here whenever we're talking about self-storage. So as you can see, we have two different sections. This is the income statement, and this is the balance sheet down here. Income statement, balance sheet. So this is going to show our annual cash flow numbers. This down here is going to show us how the property value changes over time. So potential income, we talked about that, PGI, minus our vacancy amount equals our effective gross income, okay? So essentially this is how much money we're gonna collect. If we remember the 79,000, this is how much they collected last year, so they're saying. And we're gonna look at the expenses. So the expenses, $21,213. Again, these numbers are pulled from right here. So we're gonna go back, that's gonna give us our net operating income, which is the number in which we value commercial real estate off of. It's our net operating income. Very important number. If you wanna look at how this down here is formed, this property value, we're gonna take our net operating income and divide it by our cap rate. So if you look at this formula right here, this is C11, which is our net operating income, divided by our cap rate. So if I come down here and I change this to a more aggressive, say 5%, watch what happens. I want you to keep your eyes on this cell right here. Watch what happens as I change this. So let's do 5%. Wow, the value of the property almost doubled, right? So that's why we want to be very careful and conservative with our cap rate numbers. So as we can see here, we're buying the property for $951,000, but according to the cap rate method, the property value in year one is only $681,000, which is a huge, huge disparity, okay? Then we look at if we were ever to sell it, how much commission which we would pay, which is the 5% number, the net proceeds to us. And then we look at our mortgage principal, which as we look here is how much that we borrowed from the bank. And it's gonna go down over time as we pay that mortgage off. So we can see it declines every single year. We're gonna look at our equity proceeds, which means if we were to sell it in year one on an 8.5 cap, the equity proceeds would be negative $18,000, which means we would actually have to pay the person who came through and bought that property $18,000 to get it off our hands. That doesn't even mean that we'd get our $330,000 down payment back. Right, so here's the equity proceeds, and we're gonna watch how those increase over time, and that's a twofold method. Why is that happening? Number one is because our NOI is slowly growing up over time, which is a result of inflation, a result of the rents going up and the expenses going up 2% a year. Obviously, our debt service doesn't change. We're locking those numbers in, and then we're gonna see here that our value goes up because our NOI is going up. Again, if we look at, let's call it this formula right here, that's gonna be our year 10 NOI divided by an 8.5% cap rate. Then we're gonna watch our commissions go up as the price of the property goes up, but we're gonna see our mortgage principal go down because each year we pay it off, we're gonna have to pay the bank off less and less. So if I look at my equity proceeds in year 10, I'm gonna get $354,000 out of it. Now remember, I put $330,000 into it, which means that my profit on that is really only, what, $24,000 for 10 years. Not very good. But what we do actually want to look at to try and compare apples to apples in deals is I want to look at the return analysis for the commercial. I don't want to look at the residential because this isn't a residential deal. We're not using this section down here. We're using the commercial. Return analysis commercial. So I'm going to come in here and it's going to measure two different returns for me. Number one is cash on cash. For every dollar I invested in the deal, how much did I get back? And essentially what that's saying is I put $330,000 into the property and we got $5,000 back. So how much is that as a percentage? Well, that's a 1.52%. So each and every single year, you can see the cash on cash is gonna go up, mainly because if we look at our pro forma, the cash flow is gonna go up and up and up every single year, okay? That's why that happens. The second is an IRR number. What the IRR number is the compounding of your money, okay? So that means, if I invest $100 and I earn a 10% IRR after 1 year, I'm gonna get $110 back. But if I wanna earn a 10% return in year 2, I've gotta earn 10% on top of that $110, which is $11. So that would mean I need to get back in year 2 to have a 10% IRR. I would need to get back $121, not $120, because I want my money to compound. So what the IRR number does is essentially how fast overall is your money growing on a compounded rate each and every single year. If you have any questions, read the book. It's in the book. Okay, so check that out. The chapter should explain it very good. I actually also have another video on my channel explaining IRR a little bit more in detail. But essentially, I want to shoot for an above average IRR. I can go invest in the stock market in some indexes, which I hate. I'm not a very big fan of that. But let's say I can go earn 6 or 7%, on average IRR over that time period. So I at least want to be able to beat that if I'm going to have to be active in overseeing and managing these things. So essentially what I'm going to do, is try and understand, is this a good IRR? Not really, okay? But what I can do is I can come back here and I can change my offer price Essentially, we figured out what does the deal look like at what they're offering it, and now we need to go through and edit it to show what do we think reality is, and also how low, do I have to buy this thing at for it to make financial sense. Okay, so the first thing that I noticed, that if you're never invested in real estate, probably haven't noticed, is that the expenses were extremely light. Okay, they've got no money in here for repairs. They're not paying anybody any sort of management fee. They had, did they have internet? I think they had internet, but they didn't have any sort of phone bill, right? Yeah, they had internet, $828. They didn't have any sort of phone bill. There's a lot of costs in here that they don't have. Another thing to always note is that whenever you're buying a property, the tax bill on it is likely going to go up if you're in a disclosure state. If you're in a non-disclosure state, then it can stay the same, but it's likely going to go up significantly in year one when you buy it, because governments always value property low, so they don't have to argue over the value. Whenever you buy that property, they're going to see what the property is actually worth, and they're going to tax you on that. So property tax is probably going to go up. Repairs definitely. Let's say we're going to spend $100 a month in repairs. Software, listen, I'm going to tell you guys, you're going to spend at least $200 a month in software, and probably one of their biggest expenses that they're not including is marketing. Now, here's the thing. If you have, a fully occupied facility, that's great. What that means is you're not charging high enough rents. So I would raise the rents on this property, and I would spend more money on marketing is what I would do. So I would come in here, and I would say I'm going to spend at least $10 a day on marketing, so $300 a month. And I'd put that in there. Now that would get me some higher income, so maybe I want to come over here. Maybe I want to change my vacancy rate to just 5%, and so that's going to give me higher income. It's going to be able to push the income up and kind of pay for those expenses, earn me a return. Okay, so that's my expense analysis. I think there's other things in here. I think on my income, I'm going to pay, how much is my income? I'm probably going to pay about $1,000 a year in bank fees, so $1,000 a year is $83 a month. Okay, pest control, I'm probably gonna have to deal with some pest control. I definitely need some accounting. Let's say we're not gonna do pest control. Let's say our accounting, is $100 a month, which would be cheap. And then payroll, right? We've gotta pay somebody to keep up with this place. Let's say we're gonna pay somebody, which is super cheap, $500 a month. I think that's low, but you got to pay somebody, and we got to have something in here. Again, I'm just trying to throw in some ballpark numbers. I would dig a little more into this. And then, of course, a management fee for somebody to manage the property. Let's just say it's 8%, okay? 8%. So if you want to use a percent method, which is very common, come in here, plug in 8%, and you're good to go, okay? So 8% there, $626 a month, $7,516 a year. Now let's go look at our pro forma. I did increase the rents. Well, what this shows now is that our cash flow is negative $7,700 a year. Again, I think this is more like reality, especially for me, and it shows my numbers got way worse, even though I had more income. So now I'm gonna figure out how much do I really need to buy this property for to make it a good deal, okay? And what I'm gonna do is I'm gonna come over to the purchase price, and I'm just gonna kind of plug something in here. I'm gonna say, what does it look like if I offer $750,000? So whenever I plug in $750,000, okay, my closing costs changed because that was a derivative of that. Derivative meaning it was based off of that. And also my debt changed, okay? So my monthly payment went down a lot, the amount of money I borrowed, and oh, by the way, my down payment also went down. So now I don't have to earn as much money to get a higher return because I'm investing less money in this deal. So by coming through and putting in the purchase price, a lot of different things changes. So let's come through, and that's the great thing about Excel, by the way, is that you can make one change, it's gonna impact the entire sheet, which is very important. Let's come through, let's look at the pro forma now at $750,000. Well, of course, my loan was smaller, so my debt service is smaller. So even though these numbers up here, the income and the expenses stayed the same, my debt service went down, and therefore my cash flow is now positive. Okay, my value and none of that should have changed by me changing that. So let's go look at what it looks like at a commercial. Okay, so I'm still earning 2% cash on cash. My IRR still only reaches 7% around year 14, which is really bad in my book. So I need to offer less than that. Let's see what it looks like at $650,000. And again, I have no rhyme or reason. I'm just trying to find probably a place to where my cash on cash equals about 10% or so. And then my IRR, depending on your goals, depending on if you have to raise money for the deal or not, is gonna come out to, let's call it anywhere from 12 to 25%. Let's just shoot for 12, see where we're at. Okay, so I'm gonna come through on the commercial, and wow, it looks like my IRR still isn't at 12. By the way, I probably wanna hit 12 around year 3, around year 5, and cash on cash of 10% within the first 3 or so years. So I'm gonna come through here, and I need to go obviously lower. So let's go to $500,000 for this property. That is half of what they're asking for the property. But let's see, 10% in year one, and I'm getting an IRR of 15 to 17%. So I'd like to buy this property probably at this rate, but I know they're probably not gonna offer it. So let's see if I can offer any more. Let's go up to $550,000. Okay, and if we come here, you see our cash on cash, 8, 9, 10. IRR is around 10, 12, 13. So I think that's fair, okay? I think that that's probably a pretty good spot to be on a deal like this. I would offer that, and that might be something that I could reasonably say to them, hey, check out the numbers, where am I lying? I could talk about this deal all day long. Because of the fact that it does come with extra land is one thing you'd have to value, but that's a separate project, right? Is that, you know, if I want to capitalize on that land to build more units, that's an entirely separate analysis. Maybe something we could do in another video to kind of talk about how I view additional land. But at that point, you're really becoming a developer. There's a ton of risk. There's a ton of time that comes with that. So I personally, for this deal, I'm not going to look at that for what I would buy for it. I'm buying an existing stream of income that I could potentially raise. So that is how you go out, you analyze a self-storage deal. Of course, if you want practice, you guys can use this spreadsheet I have forever. Another thing you can do is, it looks like, you know, good Lord, there's a lot of properties for sale right now. So you can underwrite these properties all day long. If you guys want, again, pick up a copy of the book, but I also have a webinar I put out not long ago, how to buy your first investment property in the next 90 days. I talk about all the steps you need to go through, all the pieces of the puzzle, including finding deals, managing deals, and getting capital for the deals. I talk about all that in that webinar. That is going to be in this description. Okay, so it's going to say webinar link. Click on it, register for that webinar, and, you know, we'll kick it off. I'll show you guys how in the next 90 days to buy your first investment property. If you like this video, if you've made it this far, I very much appreciate, you know, you watching this. I would super appreciate it if you got value out of this, to hit the subscribe button, to like this video, and to share it with a friend who could also be learning about real estate investing, getting one step closer to financial freedom. So thank you so much. Check out some other videos on my channel, and I'll see you guys next time.